webinar, and I really appreciate it. The men of Trusco and N3L appreciate it. George Smith, Garrick Moran, Faxland Street, and I really appreciate you being here. And we're busy protecting and growing our client assets and our own assets along the way. And we think these deep thoughts all the time, by the way, that I'm going to go through today. So I'm kind of going to start off with what we've been doing during the quarantine, which is exactly that. That's me. And I missed. Actually, I'm joking. It's not that wild here. We're just kind of hanging back, communing with our house pets. And so I'm going to start off with a kind of a rehash of my last webinar, where we talked about the COVID crisis. Obviously very bad, detrimental to global economic growth, but really not the key story here. The key story is debt, the sheer unprecedented amount of debt in the system, both public and private. I went over that 60% of NASDAQ companies had junk bond debt. That was of last year. It's a lot higher now. Debt issuance has been very high since the COVID crisis. So I would say that COVID was the spark, but the dynamite was the sheer amount of unprecedented levels of debt in the system. I also went over how I thought that the strong S&P or the strong market performance since the great housing crisis of 2008 was driven by the Federal Reserve. I showed this chart here where you can see during every dip in the market, the Fed runs to the rescue with some acronym, ZIRP, TWIST, QE, QE1, 2, 3. And how every time they attempted or even thought about a rate increase, the market would fall. And then they'd run in and bail it out with another program, maybe another acronym. So this is the shaky ground that the market was on prior to COVID. By the way, it's the shaky ground that the whole economy was on prior to COVID, because it was the amount of debt that was enabled by this kind of policy that is really the story here. And then what happens next is the biggest issue. So the Fed enabled an unprecedented amount of debt creation. Now the Fed's buying that debt. So again, these are all the acronyms that are currently in place where the Fed is buying. I think they bought $1 trillion worth of debt securities in 1 week, maybe 20% of the volume I've read. Can you imagine if we were all debt market participants and in 1 week, we had $1 trillion buyer that was intent on getting his trade done that week? What an incredible new incremental driver that is to the market. And that's what put a floor in the market. But we're going to be left with something significant coming out of it. And that's what I'm going to go into. I'm going to start off here with how, let me go back. So this story is about inflation and whether we're going to have it or not. And I would tell you that there are a few people that are fearing inflation, but most people do not. I would call it, I think there's a peak deflation sentiment out there that somehow or another we've conquered inflation, that it'll never happen again. We haven't seen it since the late 70s, 40, 50-year stretch. It's probably gone, right? The Fed maybe have conquered it. Let's discuss inflation, first off, what it is. Milton Friedman's definition of inflation, one of his definitions was that it is too much money chasing too few goods. So we know how we had too much money. It was the Fed, all this activity right here, the unprecedented amount of money printing that happened after '08. And here, as they continue to print money, unprecedented yet again. We know how we had too much money. We don't know how you get too few goods, because we certainly did not see that during the '08 crisis. So many people were calling for inflation after '08 because of the money printing, and they were wrong, including my old boss and hero, Arthur Laffer, who went loud and proud on an inflation call, and it didn't happen. And I think the reason why is because there were powerful disinflationary forces underway. One of them is the China trade scenario, whereas the world was outsourcing their manufacturing to China. China became the manufacturing operation for the world. And after 2008 and 9, not only did our Federal Reserve start printing money, but so did China's. And they also embarked on a mammoth infrastructure spending program, unprecedented. So here's the stimulus program in China following the great financial crisis of 2008. It was up to 70% growth. And this was all spent on infrastructure, which basically built out the world's most elegant and sophisticated logistics system like I said, in the world. And that logistics system did nothing but enable the already incredible manufacturing system that had been created in China over the last 30 years. So together, that was a mammoth disinflationary force as goods imported from China all over the world brought down prices of everything. And so that's why in Milton Friedman's equation, we had too much money. We did not have too few goods. One of the reasons is because the miracle of trade, free trade, and China's manufacturing and logistics system that was created in the interim. Here's an example of China's debt creation, which mimics ours after the '08 crisis. This is basically corporate and household debt as a percentage of GDP in China. The line is what you want to look at the top, not the bars. And then debt to GDP, of course, has been rising all through the 90s, but really accelerated after '08, '09. And you can see where non-financial corporates is the red line. That's where the majority of the debt was created. And those are companies that are investing in production and modernizing their manufacturing. And this is disinflationary. All of this is. Now I'm going to switch to the US. That's my story on why we did not have too few goods. In the US, we had huge disinflationary forces in the services sector. And it was fueled by easy money as well from the Fed. Including private equity managers, venture capital managers, and then the public equities. The inflation that I saw, going back here, forgive me, after '08, the inflation was really in financial assets. It did not show up anywhere else, like I said, not in goods, not in services, not in broad inflation, but certainly in the 300% increase in the value of the S&P amidst no earnings growth throughout that decade. So the inflation we saw was in financial assets. Going forward here to private equity assets under management. This is a conduit from the Fed money printing. VC investors, private equity investors, and public equity investors loved disruptive companies and were willing to, let's say, look the other way when a company was not profitable and actually probably didn't even have a path to profitability. They continued to fund them and back these companies, and they put up with the lack of profitability because a lot of these companies they perceived to be disruptors, game changers, new paradigm companies. Examples would be WeWork, or Uber, or Carvana, or literally thousands of companies that are public, basically NASDAQ listed, that not only have junk bond debt, but that are not profitable. There are thousands, if not millions, of companies in the US that are not profitable that have been willingly funded by eager investors, by the way, with backing from the Fed. That has driven to a significant decline in the cost of services in the US, disinflationary forces. Uber comes online and competes with taxi cabs and destroys their business because, again, they're not required to make money. They can. Amazon was not required to make money for 20 years. They could come in and compete against any industry because investors were willing to give them their investment capital without requiring them to be profitable. So they could literally undercut the world. Carvana comes into the auto business with a new model. Really, it's just a delivery. They're not required to be profitable, these companies. And their stock prices did not show any urgency for them to turn to profitability. I think that's been also a massively disinflationary force in the United States. So going back to Milton Friedman's equation of too much money chasing too few goods and services, we saw massive deflationary forces among goods and services. Are you with me? Now I'm just basically going to run through the terrible COVID crisis economic data. This is a leading economic index from the Conference Board. It's obviously terrible. And this is going to lead me to my next statement about inflation. Budget deficit, the worst since I was born. This is as bad as it was in World War II, by the way. So, and of course, they got out of that through a war. And then the Treasury cash balance at the Federal Reserve. This is money that's ready to be spent, by the way. So I just want to show you some extreme charts. Now, as for the US dollar, I don't think the world can tolerate a strong dollar anymore. They cannot tolerate the dollar being the global currency anymore. And there's a pretty good chance that the dollar is going to weaken significantly going forward. And the reason is because the Fed's going to make it happen. The Fed is on a mission to create inflation, and they're going to do it. Every single time in history when a central bank has been squared up against deflationary forces in a battle, the central bank has won. Let me tell you that inflation and money supply is not it's a blunt object to say the least. And the risk is that they create runaway inflation. And by the way, that story is going to be aided and abetted by the decline in goods and services driven by this problem of an economy. So much capacity is being taken out of our system currently. I've heard stories, for instance, that airlines are mothballing airplanes in the desert. This means that they park them indefinitely. They take the jet fuel out of the tank and they replace it with this gel stuff. And they literally dial back the entire airplane and leave it dormant. And to bring it back into service is very expensive. Every day that we see planes being mothballed, prices for seats go up because fewer seats are going to be the result. And by the way, don't forget that money supply chart. Money supply is escalating significantly as we speak in the US and elsewhere. Also, they're mothballing employees, laborers. I've heard numerous stories about people who employ the kind of low-wage wage earner, whereby they are taking PPP loans, getting the money from the feds to rehire their workforce, and their workforce does not want to come back to work because they're making more money on unemployment. We're paying people not to work currently. We're incentivizing them not to work. They will decide against coming back on to the staff or to the payroll at a lower wage. There's a significant amount of friction with that policy currently. So here we are, we're mothballing airplanes and we're mothballing people. There's going to be a significant decline in the production of goods as the trade war erupted, as COVID ruins the relationship that China had with the world. Everybody's mad at them now. China, the global trade is over. The globalization is over. China will never live this down. Europe is livid. A growing number of Americans are upset. At least we'll see huge diversification away from China. We talked to someone, an expert yesterday at an trade association in Washington, who said up to 25% of production is going to leave China post the COVID crisis. That's a significant amount, most of it in pharmaceuticals, technology, and so forth. And by the way, they might go to Vietnam, they might go to Mexico, some will be repatriated here. But the main thing is, it's seriously inflationary. It totally unwinds the mammoth deflationary force that was China. It totally, by the way, it isolates China in a lot of ways as well. So when we look back at Milton Friedman's equation, too few goods, well, we're going to guarantee it with the end of globalization. And then too few goods and services, we can guarantee that because investors are no longer going to be willing to support money-losing enterprises in the United States. Look at SoftBank. look at WeWork, look at Uber, look at these companies are going to have to raise their prices. So we're facing an equation that we haven't seen since the 70s. Too much money chasing too few goods. So I'm going to try to come up with some investment ideas for you. I'm looking at my notes presently, by the way, so forgive me. Oh, by the way, I want to tell you about going back to the idea of globalization being over. There's something else I've noticed. Multinational, multilateral organizations like the WHO and the IMF and the EU are in worse shape now than they have been perhaps ever since they were founded. Certainly, the World Health Organization has lost all credibility. The IMF has too, with Argentina's second visit to a default 2 weeks ago with Christine Lagarde's after her negotiation. And the EU is coming under significant pressure as Germany sets up barriers to immigration and movement of people from France and other countries. And we had the Brexit. Europe's falling apart. Whatever efficiencies were gained from that system are now diminished. The free trade relationship between China and the rest of the world is totally diminished now and permanently altered. The effort to repatriate manufacturing here or to move it out of China, there's a lot of friction. When you think about it, it'll be redundant. I mean, China became the manufacturing center. Then they developed a world-class, elegant logistics system to aid and abet that. And now we're going to have to create redundant manufacturing capacity elsewhere in higher cost domiciles. This will lead to higher prices. I will be surprised if I don't see higher prices within a year. What do? Well, let's go to my next chart. Hopefully it's what I want. Oh, by the way, this is what you don't do. You don't own the dollar. You don't put your money in cash. You will earn no money from cash. Money market funds, look at this chart, are hitting all-time highs currently. So this is money on the sidelines, but it's money not earning anything. As the 10-year note is under 1%, the dollar is going to yield nothing. And as it weakens versus other currencies, it is going to earn less. So you can't be in cash. You've got to find something else. The value of that will diminish going forward. And then you've got, this is institutional money funds. So the other one was retail. No different. So there's cash on the sidelines. Another thing you can't own is treasuries. Remember, they're yielding 0.5 point for the 10-year. And they're just not going to be a good investment. I'm going to go into what is a good investment. Maybe before I go into gold, I'll tell you hard assets, commodities. Emerging markets tend to do very well in inflationary periods. Remember, a lot of them produce commodities, and commodity prices tend to rise in an inflationary environment. Also, if we have inflation, it might mean the dollar's falling, and these currencies will do better with a weaker dollar. That's one place. And then, of course, everybody talks about land, and I think that's probably true. Logically, it's true, but I have not really done the work to determine how land behaves in an inflationary environment. But I will tell you this, gold and silver really outperform in inflationary environments. And by the way, for gold and silver to work, that you don't have to have inflation. You really don't. There's a lot of other drivers. The world cannot accept the dollar anymore as the preeminent global currency. They're going to have to diversify away. And they are doing it, as is visible by this very chart. You can see where this is central bank ownership of gold. They had been reducing their ownership for maybe 15 years, 20 years, and they started buying gold in earnest in 2009. And you can see there in 2019 where central bank purchases of gold have escalated significantly. And by the way, I'm a piker compared to the Central Bank of China or Germany. And I really like having that buyer on my side of the trade. This is gold, a monetary base. This is just kind of a goofy, kind of a complicated chart that I took off of somebody else's work, by the way. But I thought it was interesting as our monetary base has increased so substantially, charts that I showed last webinar, the Fed's balance sheet is moving from around 4 trillion where it was before the COVID crisis to maybe 8+ trillion. That's new money in the system. That's monetary base growth that's unprecedented in history. And so when you basically relate gold to monetary base ratio, it should be what, 5,100 an ounce. I fully expect 3,000 an ounce. I'm guessing at least 2 within maybe by the end of summer. This is the S&P 500 to gold ratio and how it looks in the bubbles. By the way, it's inverted. This is the S&P 500 being high relative to gold. So if this chart is any guide, if history is any guide, then you should see gold versus the S&P rally substantially here. And I think it started. You can see it even today. And this is this is called the Barron's Gold Mining Index of gold and silver miners. I love the miners. The cheapest gold in the world is in the ground. Gold's trading at around $17.70 maybe an ounce, but $17.50 an ounce is where it's been lately. But the cheapest gold is $1,100, and it's in the ground. And when I say $1,100, I'm talking about the all-in cost, sustaining cost of production that most of the companies that we've invested in have. And so the earnings numbers out of the gold mining group are going to be astonishing this quarter and next quarter and the following quarter, if indeed gold prices remain, elevated or up here or higher, which I do believe they're going higher. The numbers are going to be astonishing. It's all profit. Years ago, these companies rationalized their expenses and cut their debt levels substantially, took off unprofitable production. They're lean and mean now. And with the high and rising price of gold and silver, it's all profit. They're going to be putting up numbers, up 30, 40% revenue numbers and earnings numbers in the current quarter. So I challenge you, find me a group of stocks, an industry that's going to be growing its revenues and earnings 30%. And that, by the way, trades at a 4.5 multiple of cash flow currently. So that's why I'm on this group. I mean, I cannot, it's the best value by far of any group that I can find or any asset class, period, and a story. The macros are extraordinarily strong, too much money times a million, since the latest moves by the Fed. Now too few goods. With the end of globalization, the efficiencies that have been gained are now lost. And then investors that are not willing to fund unprofitable operations. And then we've mothballed the whole economy, people, airplanes, hardware. Too much money chasing too few goods. The macro is very strong. And then again, when you look at the fundamental performance of these stocks relative to stocks in the rest of the economy, they're going to be crushing numbers. It's going to be exciting. Give me a second. And this is just gold equities dislocation from spot gold. Spot gold is currently outperforming. And the reason is because these are stocks. And when we had the meltdown in the mid-March, when the S&P and the NASDAQ all just crashed, they took these stocks with them, period, end of story. But I think they're getting a bid now. The first trade is going to be a fear trade with gold. People are going to be coming onto gold more and more from here. Well, central banks are already there. Individual and institutional investors are going to be coming into the gold market from fear. But then it's going to be greed. Once they put up a quarter or two of explosive earnings, the algos, the machines, the computers get on board and take these things to new highs. And when I say new highs, 300% from here. And I'm not kidding. I'm so excited. I mean, I'm sad for the world. I'm sad on a number of fronts. COVID is obviously a terrible health risk. All the people that lost their jobs and now have to make a decision between sitting around getting free money for nothing and going back to work. I feel sorry for them. And I feel sorry for what we're left with, which is a diminished economy, diminished production base, and inflation. It could be terrible. It's debilitating. Another thing Milton Friedman said about inflation, was it's the worst tax of all. It's the invisible tax. So I'm going to go into Q&A here in a minute. And we end our quarantine May 1 in Nashville, by the way, which I'm very excited about. But until then, my daily hikes in the park and so forth have been somewhat curtailed, and this is the police state we are left with. So I wish you all the best for the rest of this quarantine. Stay safe and be aware of the risks to the global economy and protect yourself. And if I can be of service, please let us know at Trusco and N3L Capital. We'd love to just answer questions. We can do an analysis of what you're doing for very little money or possibly free if you're sweet, if you feed us, and so forth. So I'm going to go to Q&A now with the help of my production assistant. Oh, that's us. There's my email, and there's George's email, George Smith, my lucky partner. And I did get asked already one question, by the way, and it is about Bitcoin. And I get asked this a whole lot. And I don't really have a great answer, but I will tell you, I understand its appeal. And I know that younger people love it because they don't have a long history with gold. But the long history with gold is 500 years of history, and Bitcoin is very limited in regard to our history with it. So I just don't think it's I don't think that Bitcoin's is exciting because of that one thing. It's not as exciting as gold. Oh, and somebody wants me to gloat about oil prices because I've been bearish and loud and proud bearish on oil prices since 2014. And I really have. Oh, really? I started probably in 08. And the reason is there's no peak oil. It was a farce and a fallacy. We have so much oil. And by the way, we've got oil in places where it's very cheap to access. Fracking is going to shut down. Not completely, but certainly on the margin, we will see less fracking. Fracking is just an end run, if you will, around a moratorium that we had in the United States on drilling for oil. It was cheap and plentiful onshore in national parks, shallow water off of the eastern coast of Florida, west coast, and the east coast. We have too much oil. So not too much, plenty of oil. And the only scarcity is going to come from the government restricting access, which they will, certainly they will if we have a regime change in the U.S. All right, thoughts on the USO ETF. Okay, it's terrible. ETFs in many cases have lost their luster. We saw during the big meltdown in March, a number of ETFs just came unglued, especially the levered ETFs. And the USO is one of those ETFs that is completely broken down. Remember, it's priced off of futures. And the USO is like 25% of the spot price market as well, 25%. And so when people started rushing out of the USO and the USO rushed out of the spot market, it literally crashed the spot market for oil. So I would be very, very careful of ETFs in general going forward. And they are not what they seem. And I don't know the immediate solution to that. Okay, so my good friend Luke Frobe is asking thoughts on the decline of retail and the rise of online. Well, online, I mean, I think this is somewhat disinflationary. The move to online, it'll only increase, of course. And it's really going to be amazing. I cannot wait to see what we look like in a year, how much of the ordering at home trend is going to persist. But I certainly feel terrible for retailers. I'm going to do a lot less, I bet. In fact, I'm going to take fewer business trips. I love traveling, but I think I just decided all of my traveling, except for the critical business trips, are going to be leisure with my wife and friends. That's it. I just, no more hotel rooms for me. I hate them anyway. I'm sleeping less as an old man and so forth. What gold mining ETFs do I like? I gave them last week, and if you want a list, you got to come to us. What about a market short until, let's see, interesting, give me a minute. What about a market short until the effects of the depression take place? Look, it's tough to fight the Fed, and the Fed is intent on creating inflation. they are going to go and go and go and go. 3 or 4 months from now, the amount of treasury bond issuance that is going to have to take place, by the way, to fund our $3 trillion annual budget deficit is unprecedented. Who's going to buy those bonds to fund the current operations of the government? And that's not even to mention Social Security, which is underwater by $1 trillion a year, by the way. Who's going to buy it? The Fed. The Fed's going to continue. This is just a foreshadowing of what we have coming from the Fed and the Treasury. So it's hard, George. I am short. I have shorts out there. This is a choppy market. I don't think it's straight up from here, but I think the Fed's going to prevail, and they're going to risk everything to do it, everything, including our future. We're going to be left with debt and deficits, and the balance sheet at the Fed, and a government that owns more of our means of production, certainly more of the capital markets. It's going to be a mammoth encumbrance on generations to come. I couldn't be more bearish on that. Oh, another Milton Friedman quote that I hope I can remember. Oh yeah, he said, "Put the government in charge of the Sahara Desert, and it'll be out of sand in 5 years." and I'm telling you, he was a smart man and right on. Any other groups I like? Yes, it was like 5G stocks. I do like 5G a lot, but I look at the only two guys I could play are like Nokia, Ericsson. You can play Cisco, but the stocks don't act like there's a great opportunity. There's American Tower. There's some of the tower REITs. I like those. Hadn't looked at them lately. They're benefit. I know that Huawei is definitely not going to benefit, so I would think that inures to the benefit of Nokia or Ericsson. 5G, I like T-Mobile, maybe Verizon. I think they may benefit from more use of bandwidth. But that's a very good question. What gold stocks do I like? You got to come to me privately for that. We manage money for a reason. It's a business, and we love doing it. But I am not sure I'm going to give away all my secret ideas right this minute. I've given you a lot. What do I think prices are going to do for lumber and forest products? Well, that's a great question. There's a fundamental demand for that category of product. Obviously, housing mostly. I think that with interest rates low, that's beneficial. However, with the joblessness, it's very terrible, and the loss of confidence will be bad. But again, commodities do well in an inflationary environment. Oil has to be a great buy here, by the way. Has to be, for a couple of reasons. One, weakening dollar. Two, there will be weak producers in Texas and the Permian that are completely shut down, and that'll lead to higher prices. Three, Saudi Arabia, though they've got an endless supply of oil, they have a giant welfare system that depends on oil revenues. Their entire culture is on welfare. If you think ours is bad or going to be bad post-COVID with unemployment, with them paying people not to work, it's nothing compared to Saudi Arabia, where their citizens live like royalty off of oil royalties. So they need to raise prices. So I think that oil, this is probably a great time to buy oil. I might not chase it on an up day, but I think you'll wake up in 5 or 10 years and be very happy you got involved. And by the way, I think that that's the same way for precious metals, but it's going to move faster and it's much more reliable. I think it's a more of a sure thing. How does gold do during a depression? Unbelievably well. It crushed the market during the depression. It crushed the market in '01. It crushed the market in '08. By the way, following the crashes. It crushed it. And so again, I think fear will turn to greed in this group, and they'll bid them up, and they're going to be terrific. I talked to one of the biggest precious metals investors in the world yesterday. And he went through a litany of things he liked. He said central banks are buying gold. That was one thing that I already knew, and I showed you that chart. He said the world can't tolerate being on a dollar standard anymore. We talked about that. He mentioned the Chinese are the largest producer of oil and the largest consumer now. And of course, India is too. We talked about mothballing of the economy and the fact that we're going to have less stuff when we come out of this. And he said inflation is not necessary, mostly because of the relationship with the dollar. And he said we've accomplished so much from the Fed in 12 months to make gold to go up. He said first stop will be the ETFs like GDX. And then the next stop for the algos and the computers will be the gold miners. And the reason is because they've got pharmaceutical type margins over the foreseeable future. Thoughts on REITs? I like REITs. I want to own them, but we need people to be paying rent, and that worries me when they're skipping out on their rent. But their land, they're hard assets, and I think that real estate does well in an inflationary environment. So if I could find one that was super cheap and didn't have a lot of debt or something, and I mean it was a category like industrial, perhaps, I might like REITs. I'm not involved, but I gut feeling is I like them. And then inflation numbers, do I have a prediction over the? No, I don't. The CPI is manipulated. It's a gamed, rigged system. CPI is a junk. I think 30% of the CPI is a what they call owner's equivalent rent, which is literally a survey that they take of homeowners. They call them up at home and they ask them how much they think they could rent their house for this month versus last month and versus last year. So if I were to answer that call and I'm a homeowner and I mind my P's and Q's, I still wouldn't know what to answer. I might look at my mortgage and add $100 or $200 to that if I felt pretty good. If I felt really good, I might add 300. In other words, it's totally unscientific. What will CPI show me? Who knows? Those statistics are the best in the world, and they're still terrible. It's a terrible statistic. Anyway, it makes me angry, actually, now that you started it. A suggestion from the audience, by the way, 5G, Qualcomm, and MRVL. I think it's a specialty chip manufacturer. Marvel. Somebody's talking their book, so beware. Especially one of my friends. They know that thousands of my adoring fans are going to all jump on it, and then they'll sell into the stream. How cheap is the price of oil relative to gold? As cheap as it's ever been in history. Good question. Very good question. I don't have a chart on it. All right. So domestic oil production. Is it your position that domestic oil companies are going to cease land-based exploration and go offshore or whatever? All of this, by the way, is politically motivated. Let's say that this president wins the next election and he continues to deregulate. He's clearly a deregulator. Deregulation means loosening restrictions. In fact, as you may remember or you may know, in the Tax Act of 2016, they slipped in a change in the policies governing oil exploration in ANWR. ANWR is huge, 20 million acres. And there's this 1.8 million acres of it called the Coastal Plain that has perhaps 13 million barrels of oil, 13 billion barrels of oil reportedly. And he opened that up to exploration. So it may or may not happen, but that deregulatory effort is significant. He's also allowed a lot of pipelines to be built, which of course stops the bottleneck between various places, including Cushing, including Permian Basin, southeastern New Mexico, Colorado, where they produce oil, and of course the ports in Corpus Christi and New Orleans. But all that deregulatory effort lowers the cost of production and lowers the cost of producing oil. So it's all political. If you have a big lefty take over and they just are totally going to shut down oil, let me tell you, oil's going to 100. But if you have a deregulatory regime, that won't be the case. So the question also asked me, the questioner, if 50 to 60 is out of line. No, it's not out of line. If we saw, it'll be a lot more than that if we have a antagonistic regime come in. And if we continue to have deregulation, 40 might be my number. If we saw marginal producers in the frac world come out of commission. What percentage of assets in the gold arena is right? 20% is the max, I think. And I would say 10 or 5 to 10 is ballast, but it's too big of an opportunity now. I think 20 might be good for the right person. And the reason is twofold. One, you're not just betting on the macro. You're not betting on the dollar's demise or something that you really can't predict. You're not just betting on inflation. I don't think we need inflation. You're not just betting on the macro, which of course is just nebulous. You're betting on the fundamentals as well, which is basically these companies are digging for gold as we speak. They're coming out with gold ingot, and that ingot is now priced at over 1,700 and rising per ounce. When this time last year it was 1,200 per ounce. There's your math. And by the way, you can go do the work. They're trading at 4.5 times cash flow and crushing numbers, and the world's not there yet. I just feel like it's the play you can run, get a position, and wait, and the world's going to come your way, not just because of the macro, which you can't control, but because of the fundamentals. And anyway, that's that. Let's see. What percentage? The gold question I've had before. Great question about FASB 56, and I can't answer it. It's a very good question. I would fumble over my answer, but that's a very interesting question. So about airline tickets from one of my retired friends, if airline tickets skyrocketed and airlines only sell half as many seats going forward, that is inflationary to me, but the industry all of a sudden is a smaller player in the economy, therefore less impact on moving the economic inflation needle. Groceries will continue to be a full user as before. They're telling me something rather than asking a question, but here's what I'll say about the amount of goods and services in the economy. What if they had to come back and space us all out at 2 or 3 seats apart? Here's what I know. There will be fewer seats flying, fewer things made. In food, did you know that they're pouring out millions of gallons of milk currently? I've read where some chicken producers are throwing out millions of pounds of chickens that have been produced. They've shut down 3 or 4 pork plants because of COVID. Now these people are going to go on unemployment and not want to work again in the production facility. To me, that's a kneecap to the economy. I really believe we're going to come out of this with less stuff. Will there be more demand? No, I don't think so, because there's going to be fewer people with jobs and so forth. But remember, helicopter money will make up for it. And a determined Federal Reserve is going to go berserk, and they are going to win the battle against deflation. They're going to create inflation after all, and that's the biggest risk. Okay, I'm 45 minutes in. This is my second webinar, so it is a little easier than the last time. I had maybe 75 people here, and I really appreciate your attention. I hope I've framed things for you so that you can get a sense of what we do and think, and then you find a way to, contemplate that and plan your future based on that. And I'm going to do another one in the near future as well. And I may do a deep dive on hard assets outside of gold and silver. Anyway, you've been a riveting audience. Your questions are great. And I do hope to see you in my next webinar, if not sooner. Thank you.
There you go.
Did you record?
Yeah.